Very good morning, friends. So, I hope all of you are doing quite well. And I hope you saw the first two parts of Ind AS 2 as well. Today, I'm going to cover the third part on Ind AS 2. And of course, that's the final concluding part on Ind AS 2 inventory. Well, in the previous part number two, I was discussing with you the aspects in terms of the three special issues which are related to cost. And we made a discussion on number one, the concept of deferred credit terms. Then we went ahead and made a discussion on joint and byproducts with you. And then there was a third issue where we were discussing on the cost formula. I think I'm going to first of all start the journey today in terms of doing a practical question with you on the concept of cost formula. Then today my focus is mainly in terms of NRV. What is a net realizable value? What are the issues which we need to take care in terms of NRV? So that's, I think, is the last part in terms of the standard, which gives us a concluding end. And of course, towards the end of the standard, I'm going to take a very quick revision, creating a little mind map in terms of what are the major issues which we need to touch upon. So first of all, I think let's start the journey in terms of cost formula. And I think for that, I need to remind you that when we were looking in terms of cost formula, we decided that inventories can be segregated into two categories. One is what we call inventories which are not ordinarily interchangeable. And we said the other category is inventories which are ordinarily interchangeable. Now, when you say inventories are not ordinarily interchangeable, it means we are looking at all those tailor-made products. So, which means we might be looking into a jewelry industry. Basically, we can say all companies which manufacture products according to the specific requirements of the customer. In those particular cases, we decided to use a technique which is called SIM, that is Specific Identification Method. Then we said if you're looking at inventories which are ordinarily interchangeable, in those particular cases, we would always prefer a historical cost method. But as a matter of convenience, if the results approximate the cost, we said two things that number one, if we require convenience, like for example, when we look at departmental stores, it might be very difficult to take inventories using a historical cost method. So in those cases, when we say that it's going to be convenient and the results would approximate the cost, the standard also allows us to use certain non-historical cost method. Now, when I say the historical cost method, we know that we are referring to first in, first out, and a weighted average. And when we're looking at the non-historical cost method, we are focusing on the RIM, that is retail inventory method, and we're also looking at a standard cost method. So I think now with this inputs in hand, let's have a look at a practical question with you, which is also there in the study material. And I put that out here. And as we discuss the para number 21 and 22, so we're going to have a look at that particular question. So let's have a look at the question number 16 in front of you, and we'll decide which method of measurement, which technique do we need to apply. It says Mars Fashion is a new luxury retail company located in Lajpat Nagar, New Delhi. That's actually the real place. Kindly advise the accountant of the company on the necessary accounting treatment for the following items. Now, as I'm going to read the language of the question, I am going to pinpoint certain things to you which are indicative of which kind of technique is to be applied. It says one of the company's product line is beauty products, particularly cosmetics such as lipsticks, moisturizer, and compact makeup kits. Then it says the company sells hundreds of different brands of these products. It says the company sells 100 different brands of these products, and each product is quite similar, is purchased at a similar price, and it has got a short life cycle before a new product is introduced. Now, he is, trying to first of all give us information that it might be inconvenient to apply her historical cost method. And since you've got hundreds of different brands of product, I think it certainly pinpoints towards an inconvenience. It's a departmental store which is, into retail company, and they're selling different lines of beauty product. So some way or the other, with this particular language, is indicating you that it might be, inconvenient to apply historical cost method. Let's read further. Then he says the sales manager, okay, I just missed a line. Each product is quite similar, is purchased at similar price, and has got a short life cycle before a new product is introduced. The point of sale and inventory system is not yet fully functioning in this department. The sales manager is unsure of the cost of each product but is confident of the selling price and has reliably informed you that the company takes a GP, average GP margin, 65% on each line. Now, if you recall, in terms of your CA foundation in CPT, the use of a retail inventory method, that is what you call RIM, assumes first of all that you're going to club all similar items which are similarly priced and have a similar margin in them. Now, he's made two backgrounds on that. One is that the company has got hundreds of different brands of these products. Another input which is given in the question is in terms of the fact that the company is very confident and it knows that what is the gross profit margin on each product line. So I think the matter of convenience is indicated when we say that they've got different brands of product. So that is indicative that we would land up using a non-historical cost method. And I think the inputs that they've got different brands with a similar gross margin rate is again indicative of the fact that within the non-historical cost methods, we would land up using retail inventory method. So I think this becomes a case where the company would apply the techniques for measurement in terms of RIM, retail inventory method. Let's have a look at another point, number B, as well. It says Mars Fashion also sells handbag, and the company is manufacturing their own handbags as they wish to be assured of the quality and the craftsmanship which goes into each handbag. It's one thing which is very, pinpointing again some information is they wish to be assured of the quality and craftsmanship which goes into each handbag. The handbags are manufactured in India in the head office factory, which is making bags for the last 50 years. Now, people would generally feel, that this kind of information is purely emotional in nature. This is nothing to do in terms of inventory valuation. But when you've been manufacturing these back for the last 50 years, one thing is pretty sure that if you were to decide what the cost should be, you know what I am thinking. So if you decide in terms of what the cost should be, which is a standard cost, it would generally approximate your actual cost as well. Because if you've been doing a manufacturing for the couple last 50 years, then I think one would always ensure that you always predetermine a cost which would approximate the actual cost incurred. Normally, Mars manufactures 1 lakh bags a year in the handbag division, which uses 15% space and overheads of the head office factory. The division has got 10 people and is seen as an efficient division within the overall company. So I think this is again indicative of the fact that since the company has been manufacturing the bags for the last 50 years, we are given the data which is normally, that means all that information would go in determining the standard cost of the inventory. And as we just said, that since you've been doing it for the last 50 years, it would generally approximate the actual cost as well. So again, this is indirectly giving us a hint that we are applying a standard cost, a non-historical cost method in terms of standard cost. He says, in accordance with Ind AS 2, explain how these items in A and B should be measured. So I think in this particular question, of course, I'm not documenting much. I think the language of the question is quite indicative of the fact that we are applying which technique in terms of measurement. Okay, so that was a little spillover from what we discussed in the previous class with you. And I thought, once that method gets sink in, we could take the discussion further. Okay, now I am going to focus on my fourth issue. If you recall, in terms of Ind AS 2, we have divided our entire Ind AS 2 in a complete four sections. The first section we decided was we focused on the definition of inventory. Then we went to the second section of the standard, and that was dealing in terms of measurement, where the focus was in terms of para 9 and para number 32. Then we moved to the third section of the standard, understanding the cost, where we saw what is included, what is excluded, and what may or may not be included. We also saw the special issues related to cost in terms of deferred credit, in terms of joint and byproducts, and in terms of the cost formula. Now we are focusing on the fourth section of the standard. And trust me, when you're studying any particular standard, it is very easy to study the different sections, but in order to develop the relationship in terms of various sections is very important. So that, once you're revising that particular standard, it should go in front of your map. The mapping should be very clear, how things would move in a chronological order. So that's what I'm going to do towards the end also. Give you a very small little mind map, not a very detailed one, which will give you an insight of how we could actually revise the standard as well. So on that inputs now, let's go to the standard once again, and let's come to the focus on what is NRV. Now, if you look at the para number 6 of Ind AS 2, it defines the term NRV. It says NRV is estimated selling price. There is very deep meaning to the word estimated. I'll be very shortly coming to the term estimated selling price. In the ordinary course of business, then it says less the estimated cost of completion, and it says less the estimated cost necessary to make the sale. Well, in fact, if you recall, when we were doing a question on joint and byproducts, we did have a little feel in terms of, the calculation of NRV. We did the calculation of NRV of a byproduct. Now, let me get into a little more detail in terms of the NRV definition. I'll focus on the word estimated a few minutes later, but we are given that NRV is estimated selling price minus estimated cost of completion minus estimated cost necessary to make sale. Now, let me do one thing. Let me just take you back and do some analysis. So I am on the fourth section, and this is on the NRV, net realizable value. Don't worry, these are not the notes right now. I think I'm just going to first get my chain of thought clear. I don't know why this triangle gets made every time. Let me just clear this out. Okay, so I think now the triangle is gone finally. So we are looking at the net realizable value. And in this particular case, if you look at the definition, the NRV says it is the estimated. It says it is the estimated selling price minus, there are two things. It says estimated cost of completion. I think let me put it as COC, cost of completion, a little short form. And we also reduce the estimated cost necessary to make sale. We also reduce the estimated cost which is necessary to make the sale. When I look at this definition of NRV, my mind starts working on that, is this definition related to FG or is this definition related to WIP? Of course, not to the raw material, because there is no concept in terms of NRV as far as raw material consumed is concerned. Because raw material consumed, you remember, was taken at cost or replacement cost, whichever is less. So naturally, when you're looking at the definition of NRV, one thing is pretty clear, that the definition of NRV is to be seen with reference to WIP as well as FG, not with reference to raw material. Now, let me do one thing. I think we should segregate this definition in terms of FG separately and in terms of WIP separately. And at the same time, let us also understand, the logic of why the estimated cost of completion is being reduced. I think let's do one thing. Let's take a small example. Just imagine that I am looking at finished goods. Let's say I'm looking at finished goods, mind you, not WIP. Now, in terms of finished goods, let's say the cost of the finished goods is 100, and let's say the NRV is, let's say, 120. Now, you would apply the para number 9 and decide on the measurement of inventory, the lower of cost or NRV. So it's going to be measured at 100 undoubtedly. Now, let's say that we are looking at WIP. Now, let's say the cost of WIP is given to me 80. Now, one thing is pretty sure, you cannot compare this 80 vis-a-vis 120, because 120 is the NRV of the finished goods and 80 is supposed to be the cost of WIP. They're not on a comparable basis. But if I were to ask you that what is the estimated cost of completion, I'm sure all of you can logically decide that if 80 is the cost of WIP and 100 is the cost of FG, we can clearly decide that there is going to be another 20 which is required to complete the product. Because if you've already incurred 80 and the cost of the FG is 100, so the further estimated cost required is another 20 rupees. Now, we've got two possible alternatives to understand this in a logical perspective. Now, hear this very carefully. You know what I should do? Either I should add another 20 to the cost and then compare it with 120, correct? You should add the estimated cost of completion and then compare it with 120, then they become a comparable basis. Or alternatively, just imagine what we should do, that we should compare this 80. Instead of adding the 20, why don't you reduce the 20 from the NRV? Isn't that simple mathematics? Then when you compare the cost versus the NRV, then you need the cost of WIP, you need the NRV of WIP. So one alternative is that you add 20 to the cost so that it becomes comparable to 120, or the other alternative is you reduce 20 from NRV so that it's comparable to 80. Now, based on this particular logic, you can see that when we're looking at the concept of NRV, we are reducing this estimated cost of completion. But this estimated cost of completion is to be reduced only in terms of WIP, not in terms of FG. Which means we can certainly say one thing at this point, that when you are calculating the net realizable value for FG, hear this carefully, when you're calculating the NRV of the FG, you would take the estimated selling price of the FG minus the estimated cost necessary to make sale. Don't worry, I'm going to document that. And when you consider the NRV of WIP, you take the estimated selling price of FG, mind you. The estimated selling price is always for the FG, whether you're taking NRV for WIP or FG. I know many students at times tend to get confused. And they believe that when you're taking the NRV of WIP, we need to consider the estimated selling price of WIP. Well, there cannot be an estimated selling price of WIP because that's a semi-complete goods. So I think what we need to do at this end to get a clarity of thought is that we should first of all segregate the definition of net realizable value into two different parts. To get a clarity of thought, we can say, let's give a separate definition for FG and let's give a separate definition for WIP. So that once you're doing a question, you clearly know that net realizable value for FG is what and WIP is what. So when you go to consider FG, we will consider the word estimated. I know I'm yet to elaborate the word estimated, which I'm going to shortly do. So we're going to take the estimated selling price of the finished goods, and only one thing is to be reduced, and that is the estimated cost necessary to make sale. The estimated cost which is necessary to make the sale. So can you give an example in terms of what is a necessary cost to make a sale? Well, I would say for example, if you're giving a sales commission to your agent, let's say if your price is 100 rupees and you're going to give him a 10% commission, then we would say that out of 100, which is the estimated selling price, you reduce that 10% commission 10 and you get a net realizable value, which is 90. Similarly, when I'm looking at WIP, then I am considering the estimated selling price. And I think let me make it very clear. This is again the selling price of the finished goods itself, not the WIP, remember. Because from this, we're going to make a reduction in terms of the estimated cost of completion. We will reduce the estimated cost of completion. That means converting the WIP into finished goods. So whatever cost is incurred in converting the WIP in terms of finished goods, and then finally, we would also reduce the estimated cost necessary to make the sale. Estimated cost necessary to make the sale. So I think we've done one aspect in terms of NRV. I'll put it as point one, that we've understood that NRV for FG is supposed to be the estimated selling price minus only the cost necessary to make sale. But in terms of WIP, there are two reductions. We need to reduce the estimated cost of converting the WIP into FG and also the cost necessary to make the sale. And we've also understood the larger logic why this is reduced in terms of NRV. Now, another thing, which comes to the mind when I look at the definition of NRV, and that is when you consider the definition of NRV, whether it is FG or whether it is a WIP, the focus is in two things. One is the word selling price and one is the word estimated. Though the word estimated is there in all places, you can see that we're continuously using the word estimated at all these places. So I think my mind is now working on the fact that what is the deeper meaning in terms of estimated and in terms of selling price. So let's focus first of all on the word selling price, and then I think we'll focus on the word estimated. The deeper question what comes to the mind is there is a concept what we call fair value. And there is a concept what we're looking in terms of Ind AS 2 is the net realizable value. The question what comes to the mind is that is NRV and the fair value two different terms, or are they supposed to be similar terms? Well, you would say, so what is the connection? And why you are talking in terms of fair value and NRV? In fact, the interesting part is if you look at the accounting standard 2, I'm looking at the IGAP accounting standard 2, it never spoke in terms of fair value. But if you look at the Ind AS 2, in the definition section itself, apart from the NRV, they're also giving you a definition of a fair value. Because they wanted us a clarification at the end that fair value and NRV are two different concepts. Now, let me first of all elaborate something to you. Please hear this very carefully. When I look at the concept of a fair value, the concept of fair value is based on Ind AS 113. And the concept of NRV is what we are discussing in Ind AS 2. At the first instance, let me tell you that these are two different concepts altogether. Now, what is the difference? I'll just give you some very basic inputs at this stage without getting into the nitty-gritties in terms of Ind AS 113. Because Ind AS 113, when we're going to do that standard, we're going to see in much more deeper detail that what is the concept of fair value. But I think I want to take your focus on the standard and at least read the definition of fair value to give you a very basic inputs. It says the fair value is the price that would be received to sell an asset. Fair value is the price that would be received to sell an asset. You must be wondering why I am shouting at the word that it is received. And this word is to sell an asset. The main function is that a fair value is supposed to be called an exit price. Now you can understand why we say it's an exit price, because if you're going to sell the asset, basically you're looking at an exit of the asset. So the fair value is based on what we call an exit price, that if I have to sell an asset, what would I receive? Then he says fair value also is defined in terms of liability, that it is what is paid to transfer a liability. I think I don't want to read further. Since we're looking at inventories, and in terms of inventory, the focus is in terms of asset, I think I just want to pick up the initial part of the definition. The other aspects can be well understood when we come to the concept of Ind AS 113. Then we'll see this definition in a larger, more analytical way. So one thing is pretty clear, that when you say the fair value is the price that would be received to sell an asset, it is indicative of what we say an exit price. Now, if you look at the concept in terms of a net realizable value, it is not an exit price. It is based on a selling price. And a selling price is something, which you always say that if I have to buy buy a particular item, what is the price I'm going to pay? So it is technically called an entry price. So like for example, if I were to say that I want to buy this pen, then it is called an entry price. So if I want to buy this pen, it's like an entry. And if you say that I'm going to sell this pen, then it is like an exit. So the fair value, you can say, is based on what we call an exit price. But when you look at the concept of NRV, which is based on a selling price, is based on what we call an entry price. So in simple words, as I said, that when you say that I want to buy a pen, then what is the price I'm going to pay to buy this pen? So I'm going to get the asset and I am going to pay for it. So I'm going to pay. So entry price means that I'm going to pay to acquire. But when I say a fair value, it says what do I receive to sell? Can you see the difference in terms of pay and receive? I will sell it. So what is the money I will receive? I'm going to buy this pen. So what is the money I'm going to pay? So they are absolutely two different concepts altogether. So the Ind AS 2 has made it very clear that when you're looking in terms of the NRV, the second point is that the NRV and the fair value are absolutely different concepts. So, but is it possible that in some cases, not all, the entry and the exit price might be same? The price which you pay to acquire the asset and the price which you're going to get to sell the asset might be equal? Yes, it can be. So there could be instances where the entry and the exit price is same. Consequently, the selling price and the fair value become same. But generally, I said generally, the concept of fair value and the net realizable value is going to be totally different. So in this particular case, we can certainly say one thing, that as far as Ind AS 2 is concerned, it is based on a selling price, an entry price, and not on the concept of an exit price, not on the concept of fair value. Well, I think this is just to broaden your perspectives. Though, if you look at the education material, there has been a question also which says to elaborate the concept in terms of NRV and a fair value. Do you know, sometimes when I'm looking at the examination paper, and I think when you look at the expectations of the students also, generally, the perception is that we are studying accounting, so we should be getting some traditional kind of questions. And in those traditional kind of questions, the expectation is that we will get questions where we're going to pass entries, where we're going to make ledger accounts, and we'll get a very less kind of questions where there might be case studies. I think, let me tell you, that now if you look at the papers which are coming off late, financial reporting is not a paper on the traditional accounting concept. It is a paper which is focusing on the larger concept. So you need to study the concept and you're going to get case studies based on that. So the demand of the paper is very different because many people at times also ask me, so why do you teach from the text of the standard? We don't find people teaching from the text. Well, I think it is, the law, the Indian accounting standard text is like the law which governs the accounting. And I think we need to interpret that in the right sense. You would study any subject related to law, whether it's company law, whether it's direct taxes or indirect taxes. To get the right interpretation, we always look at the text of the law. So why not in terms of Ind AS? And trust me, when you're going to look at that, your conceptual knowledge is going to certainly widen, not only from the examination point of view, but also from a practical life point of view. You would understand the subject in the right sense. Okay, so this was another clarification with reference to fair value and NRV. So I think we focused on the word selling price. Now I think I've got to focus another word on the word estimated. The other focus word is estimated, and I think I want to create a little focus in terms of estimated word as well. The question arises that when you calculate the NRV, when do you calculate the NRV? Now, the obvious answer is if I were to make a time scale, let's say this is the balance sheet date, and we all know that we are looking at the inventory valuation. We're looking at the measurement principles on the balance sheet date. So you would say that we need to determine the NRV on the balance sheet date. Agreed. We certainly determine the net realizable value on the balance sheet date, but to determine the NRV, what do we do? Well, we will pick up the most recent sale. We will pick up the most recent sale on the balance sheet date, and we will take that recent sale as a base to calculate the net realizable value. But trust me, you can never study a particular standard on a standalone basis. You need to interpret the standard considering, the other standards as well. Now, let me broaden your horizon. Now, if you remember, there is also a date, what we call the date when the financial statements are approved by the board of directors of the company. Oh, so sir, are you trying to remind us in terms of accounting standard 4? Well, now since we are studying the Indian accounting standard, I think we should get into the habit of, naming and numbering the Indian accounting standard. The corresponding standard on AS4 in the Ind AS is Ind AS 10. So we know that there is a concept called events occurring after the balance sheet date. In terms of Ind AS, we say it is events after reporting period. So there might be events which will occur in this period. There might be events which will occur after the reporting period. That means between the balance sheet date and the date when the financial statements are approved. Though we're going to see the details related to Ind AS 10, which events are adjusting or which events are non-adjusting, I think that's not the agenda right now. But let me tell you that when you say the word estimated, the question rises, what is the date when you estimate? The date when you go to estimate is the balance sheet date along with Ind AS 10. You heard me correct. Don't worry, I'm going to pen down all these notes. I'm just giving you the chain of thoughts. Then we'll make some consolidated notes put together. So we are saying that when you're looking in terms of the date when the estimation of the selling price would take place, we need to consider the impact of Ind AS 10 as well. Because even if you look at Ind AS 10 and you look at the para number 9, they made a very clear-cut mention that the selling price of the inventory in this particular period, is always a reliable basis of measuring the NRV of the inventory on the balance sheet date. So provided, of course, that selling price relates to the conditions which existed on the balance sheet date. So the word estimated means that you got to estimate things on the balance sheet date with the impact of Ind AS 10. So a little recap in terms of what we've discussed so far. I'll tell you, we have discussed a total of three aspects with you. The aspect number one, that the NRV is to be seen with reference to WIP and FG separately. So we have segregated the definition of what is for FG and what is for WIP. That's one. Second, as a matter of clarification, we've clarified that the concept of fair value and NRV are two different concepts altogether. We said the fair value is based on the concept of an exit price, and the concept of NRV is based on an entry price. The exit price focuses on that what will I receive to sell, and the concept of entry price focuses on what will I pay to acquire an asset. So what do you pay to acquire is an entry price, and what do you receive to sell is an exit price. So NRV is based on the entry price and not an exit price. And the third focus is in terms of the word estimation, that estimation of NRV is generally always done on the balance sheet date, considering the most recent sale. But we also need to consider the impact of Ind AS 10 events. So any question on that? Yes, don't worry, we're going to do a question on that as well. Another thing, what comes to my mind, which I can connect you in terms of the selling price concept, let me put that as number 4. Another concept is that when you calculate the net realizable value, you say that we're going to consider the estimated selling price. We say we'll consider the estimated selling price, and the question arises, with selling price, are you looking at the journal selling prices prevailing in the market? Because sometimes the companies would be producing inventory against specific orders of the customer. So they might have already entered into a contract with the customer. And if you've already entered into a contract with a customer, then when you're calculating the NRV, instead of taking the journal selling price, we will take the contract price. So we need to be also careful on this agenda, that when you're calculating the net realizable value, we need to consider that what is the contract price. That means the inventory of the company could comprise of two different portions. One portion which is produced against specific contract of the customer, then the NRV would consider the contract price. And if there is inventory which is not against any customer order, then we consider the journal selling prices prevailing in the market. That's another input. Next, number 5. When you're looking in terms of NRV, Ind AS 2 also tells us another clarification, that generally, I'm being very careful in the words I'm saying generally, when you consider that inventories are damaged, when you consider that the inventories are damaged, or when you consider that inventories might be obsolete in nature, we will generally go with the presumption that NRV is less than cost. So we will end up measuring the inventory at net realizable value. So in all those cases, when we are given that the inventory is obsolete in nature, the inventory is damaged, there will be always a general belief that the NRV is always lesser than cost. So damaged and obsolete inventories would invariably be measured at NRV. So I think a couple of things, and now I have another agenda to elaborate as well. But I think before I elaborate that, I think I need to explain that also with a practical example. So let me first take a small little example to illustrate another agenda related to the concept of NRV. Imagine We are looking at first year and second year. Let us say at the end of the first year, the cost of the inventory is 10 lakhs. And let's say the NRV of this inventory is, let's say, 9 lakh. So you would measure this inventory at net realizable value, considering the parameters in terms of para number 9, considering it's an FG. So you took it at 9 lakhs. So what is the write down? If one were to technically ask what is the write down, we would say at the end of first year, 1 lakh rupees of write down is taken to the profit and loss account. Let's assume that this inventory is not yet sold at the end of the second year and it is still in stock. So now we've got effectively the book value of this inventory. Mind you, since you took the inventory at 9 lakhs on the first balance sheet date, then naturally the book value of this inventory, the carrying amount of the inventory on the second balance sheet date is supposed to be 9 lakhs. And I now find that the net realizable value is, let's say, to the extent of 11 lakhs. Now the question arises, since the NRV has actually gone up, so can I increase the value of this inventory or not? Now remember one very important rule. When you're sitting at the end of the second year and you want to apply the concept of para number 9, let me give you one clarity. You will not compare the book value versus the NRV. On the second balance sheet date, you would compare the original cost, that is 10 lakh, versus the NRV, that is 11 lakhs, to decide the inventory valuation. And the lower of the two would mean that inventory is taken at 10 lakhs. I repeat, on the second balance sheet date, you would not compare the book value versus the NRV. You need to compare the original cost versus NRV to decide that the inventory can be taken at 10 lakh. Now, if the inventory can be taken at 10 lakh, that means you can increase this inventory by another 1 lakh, which means you can go in for a reversal. Technically, we can say a reversal of the write down. That means whatever is the write down of inventory which is made on the first balance sheet date, you can reverse that at the end of the second balance sheet date. But this is just a chance that the entire 1 lakh rupees is getting reversed. Let's assume that the NRV is to the extent of, let's say, 9.6 lakh. Then you would compare the 10 lakh versus 9.6. So in that particular case, the inventory can be taken at 9.6. And in this particular case, if you compare that 9 versus 9.6, the reversal is going to be equal to zero point 0.6 lakhs only. And remember, the reversal can never exceed the amount of original write down, because you cannot bring the inventory more than the original cost at any stage. So whatever you reverse at the second balance sheet date can never exceed the amount of write down which you did on the first balance sheet date. Don't worry, I have another question on this in my collection, which we're going to do. But I think first of all, let's take some recap and get some issues very clear in terms of what we need to think in terms of NRV. So let me, I think, first of all, come to the concepts of NRV, and I think let's revise this at the back of the mind. So I think I'm going to first make some formal notes to you on the NRV section so that we can then take you to some practical questions also. And as I'm going to give you notes, one or two small little issues which I didn't mention intentionally, I'm just going to add them out here as well. So I think let's make the section number 4. So in my section number 4, I am discussing the concept of net realizable value. I'm considering the concept of net realizable value. And now there are certain key things to be kept in mind. Number one, when we apply the para number 9 and we compare the cost versus NRV, which I didn't tell you earlier. No, I told you that you compare them, but I'm going to tell you something extra. So when you compare the cost versus NRV in terms of para number 9, the question arises that do we make a comparison item by item? Or do we make a comparison group wise? The question rises to make a comparison for the purpose of para number 9. Do we compare item by item or can we group items as well? Well, remember one thing. You cannot say that WIP is one group, FG is another group. So let me club all the FG and let me club all the WIP. We cannot do that. You cannot create groups on the basis of WIP and FG. Grouping can be done only on the basis that the items have got a similar use. Grouping can be done only on the basis that they've got a similar nature and a similar use. Then you can do grouping. So generally, we are saying generally the comparison has to be on a item by item basis. But if the examiner gives us information that these items are similar in use, then you can make a group of all those items, get the cost of all those items put together, get the NRV of all the items put together, compare the total cost and the total NRV. That's one. Second, I've already given you, and I'm just putting that note once again, that when you consider the definition of NRV, the definition of NRV for FG and for WIP are different. We got to have a different NRV definition. So we said in terms of FG, we consider the estimated selling price minus the estimated cost of completion. Sorry, not out here. So let me cut this out. And minus the estimated cost necessary to make sale. Minus the estimated cost which is necessary to make sale. And in terms of WIP, we consider this also, we consider this also, we consider this also. So that focuses that we've got a different definition of NRV for FG as well as WIP. Number 3, we made a focus on the word that when we use the word estimation, when we use the word estimated, we said that the estimation is done based on recent sale, on balance sheet date plus the impact of Ind AS 10. Plus the impact of Ind AS 10. So we'll also have to look into the subsequent events arising post the balance sheet date and see that do they impact the estimation of NRV on a balance sheet date. Number 4, we focused on the fact that when we say the word selling price, we said that we've got two kinds of inventory. We said we've got two kinds of inventory. One is against, if you've got inventory against specific contracts. If you've got inventory against specific contracts, then instead of taking the selling price, you would consider the contract price. Instead of considering the journal selling price, you would consider the contract price. And if it is not against specific contracts, then you would consider the journal selling prices. We will consider the journal selling prices in that particular case. Okay, then we had another fifth issue to you. And the fifth issue is that generally, we said generally, if you're looking in terms of damaged inventories, if you're looking in terms of obsolete inventories, we will have the general presumption that NRV is going to be generally lesser as compared to cost. So these kind of inventories will be generally taken at NRV. And finally, I give you another sixth issue as well related to NRV. And I said that in terms of NRV, just remember that when you look at a reversal of original write down, when we look at the reversal of original write down, we need to remember that it cannot exceed the original write down. It cannot exceed the original write down. So you can reverse what you wrote off, but the amount of reversal cannot exceed the amount of original write down. I think it's now time to do some practical questions with you based on the concept of net realizable value. And I think the sixth one is the main issue which I want to deal with. So I think let me now come to a few questions with you where we can have a look at this. And then I'll also make a run through in terms of what questions we have done, which questions you can actually do as well. Well, if you look at the aspect in terms of NRV, the question which I just mentioned and I've elaborated that NRV and the fair value are two different concepts. And I explained to you that what is a difference between the NRV and the fair value. So this was just to enhance your knowledge on that. Now, I think my focus is first of all coming on the question number 14 and the question number 15 with you. Question number 14 says Sun Pharma, a renowned company in the field of pharmaceuticals, has the four items of inventory. You're given the cost of all the four and the NRV of all the four. And then he says, determine the value of inventory if you apply the para number 9 on item to item. And if you apply them on a group basis, though in this particular question, we are not given any information which tells us that can we group these items or not. So he says, just show me the application if you do it on item by item. So if you compare on item by item, then A will be taken at 1900, B will be taken at 5000, C will be taken at 4400, and D would be taken at 2990 because you'll compare the individual cost vis-a-vis the NRV. But if you make a group comparison, you'll take the total 14,600 vis-a-vis 14,540. And in that particular case, the entire inventory will be measured at 14,540. I think that's pretty simple and straight indeed. Now let's come to the most interesting question which came in RTPs in May 2018. I think I find this as a very interesting and a good question indeed, conceptually based on the concept of measurements, the reversal of the write down. I think it's one of the best questions in terms of Ind AS 2. Let's, I think, read this question and I'm going to solve this question with you. It says on 31st March X1, inventory of A includes spare parts, which it has been supplying to a number of different customers for some year. The cost of the spare part is 10 million based on the retail prices on 31st March, that is the balance sheet date. The expected selling price of the spare part is 12 million. I think let me start noting down the data as well. We can clearly see that the financial year is April to March. So I think let's also simultaneously solve this question number 15. So let's get the facts of the question number 15 with us. So let me make the first year and let me make the second year. So let's take a time scale. This is 1st April X0 and it is ending on March X1 as good as 1st April X1 and ending on March X2. Now we're given the inputs based on the first balance sheet date. So let's get the data. We are given the cost of the inventory and we are given the NRV of this inventory. So let's, I think, carefully pick up the data. It says on March X1, the cost is 10 million and the expected selling price is 12 million. Now, I am not given any estimated cost to make sale. So I think let's read further if there is any information. Then he says on 15th April, due to market fluctuations, the expected selling price reduces to 8 million. The estimated selling expense required to make the sale is zero point 0.5 million. So he's giving you the information that there is an estimated cost necessary to make the sale, and that's zero point 0.5. So we given on 15th April, due to market fluctuations, the expected selling price reduces to 8 million. So I think let's organize the data on two different dates. So the cost is given to me 10 million undoubtedly. And in terms of the estimated selling price, it is 12 million on this date. And there is an estimated cost necessary to make the sale, which is 0.5 million. So the NRV on this date is 11.5. Look at the data very carefully. So if I'm just sitting on the balance sheet date, we know the cost, we know the estimated selling price is 12, and we know the estimated cost necessary to make the sale. But then he gives you another data, which is on 15th April. He gives me another data on 15th April, which is like after the balance sheet date. And I assume it's before the approval. Let's see if the date of approval is given. He says on 15th April, due to market fluctuations, the expected price reduces to 8 million. And the financial statements are approved by the board of directors on 20th April X1. So we given that the financial statements are getting approved on 20th April. So one thing is very clear, that the period for the purpose of Ind AS 10, the period for the purpose of Ind AS 10 is from 31st March X1 till 20th April. Now on one hand, we need to apply the concept of estimating the NRV considering the impact of Ind AS 10. Mind the words. When I'm sitting on 31st March X1, I knew the NRV is 11.5, but due to the impact of Ind AS 10, we are also given clearly that the market prices, I think, fell down to 8 million. Yes, and 0.5 million is the estimated cost. So we can say the NRV based on 15th April is 8 million minus 0.5 million, that works out at 7.5 million. Now the question arises that because of the fall in prices between the balance sheet date and the date when the financial statements are approved, do we go back and change the inventory valuation on 31st March? I would say yes, without giving you much detailed reason. Because you'll be able to appreciate this better once we do Ind AS 10 and I elaborate you the concept of para number 9B. And that's the reason, if you notice, what I've done something, you can see that on the top of question number 15, I've also very clearly said it's an application of para number 9B, clause number 2 of Ind AS 10, which elaborates when do we consider the impact of Ind AS 10 on the valuation of inventory. So for the time being, I would say just accept that, but we'll understand the larger logic when we come to Ind AS 10. I'll remind you of this particular question also when I come to Ind AS 10. So one thing which we are going with, accepting the para number 9 of Ind AS 10, we are saying that the fall in the NRV, the impact of Ind AS 10 would be taken, and this NRV will be considered to be 7.5. So we're going to value the inventory at 7.5 million. Applying the concept of para number 9, you would value the inventory at 7.5 million itself. So there is a write down. There is a write down of inventory to the extent of 2.5 million on the first balance sheet date. That's one. Now I think let's take further. So I think the first requirement of the question is done. What is the value of inventory on 31st March X1? So on 31st March X1, the examiner is testing your knowledge on, the impact of Ind AS 10 on inventory valuation. So he's indirectly testing you that do you know that for Ind AS 2, we also need to consider the impact of Ind AS 10 as well. Moving further, it says on 31st March X2, directors noted that such inventory is still unsold and lying in the warehouse of the company. The directors believe that the inventory is in a saleable condition and active marketing would result in immediate sale. Since the market conditions have improved, the estimated selling price is 11 million, but the estimated selling expense, the estimated cost necessary to make the sale is still zero point 0.5 million, giving me an NRV 10.5. So I think let's come back. So we can now focus that on 31st March X2, we have the book value that is 7.5. Mind you, I'm being very careful with the wordings. I said there is a book value 7.5. And I said if I'm looking at the NRV is supposed to be, we just read that the NRV is 11 minus zero point 0.5. So the NRV is going to be 11 million minus 0.5 million, that works out at 10.5. But as we decided earlier, we will not compare the book value versus NRV. On a subsequent balance sheet date, you would apply the concept of para 9, not comparing the book value of the inventory versus NRV. You would compare the original cost, which is 10 million, versus the NRV. So considering whichever is lower, the cost or the NRV, we would consider the inventory at 10 million. That means you can scale up the value of inventory on 31st March X2. So we can now increase this inventory to 10 million. That means we can increase it by 2.5 million, which would mean the entire reversal of what was done on the first balance sheet date. It's just a chance that the NRV on the second balance sheet date, the cost, the NRV on the second balance sheet date is more than 10 million. Let's assume for a little understanding, let's say if this 10.5 million was, let's say 9.5, then you would have compared NRV of 9.5 versus original cost of 10, and we would have increased the inventory to 9.5. So you would have reversed only 2 million in that particular case. So I think that's a wonderful question indeed. So in any case, when you're presenting this particular question in the exam, of course, you need to go on a step-by-step basis, telling the examiner on 31st March, you're looking at the application of parent 9 along with the impact of Ind AS 10. Then on the second balance sheet date, you're looking at the impact of reversal of write-down. Okay, now we are done with all the concepts in terms of this particular Ind AS, but I think, as I said, I'd like to first make a little walkthrough in terms of the questions we have covered, because few questions I'm going to give you to try back home. And I know you must be thinking, so where are we going to get the answers as well? Well, in those regular classes, of course, the answers would also be shared with you. Right now the questions are appearing, but then you will get a question book itself, which is going to contain the questions with the answers arranged very well. So in terms of the question number 1, I have already covered that in the class. In terms of the question number 2, I have not covered that in the class, because question number 2 is more to get a little more conceptual clarity, because sometimes some students want something extra in life. So question number 2 is meant for them because it's nothing much to do with the examination perspective. So question number 2 is for extra reading. So in my classes, of course, I would also be pinpointing, because I have put all the questions in the book, and it's, I think, humanly impossible for me to teach them, humanly impossible for you to learn them. So in any case, I would also be giving you, what I call MTP, not the mock test papers, but the must try problems. which questions have to be done before the exams, and during the course of your study, which questions is for extra reading. So that question number 2 is for extra reading. Question 3 also slightly for extra reading. Fourth, I have covered. Fifth, also I have covered if you've heard me well. And sixth is just a clarification that, earlier in terms of AS2, it used to talk in terms of excise duty. Now we talk in terms of GST. The concept is the same. Question number 7th, I have covered with you. I've done that question number 7 indirectly. So eighth, you can apply that in terms of the 3 cases which we discussed on the concept of recovery. Ninth, I've done. 10th, I've done. 11th goes homework to you. And question 12th I've done, and 13th is goes homework to you. 14th I've done, 15th I've done, 16th I've done, 17th is a CPT based question, and 18, 19 is again meant for extra reading itself. So I think now before I end my concept with you on this particular Ind AS, just a few minutes on mapping the concept at the back of the mind. I'm not discussing anything. I'm just taking 2 minutes to, put the standard, bind the standard in your minds. When you're going to sit down and make a revision in terms of this particular Ind AS, your mind should start working something like this. That your Ind AS 2 is divided in terms of 4 sections. You need to concentrate on the definition. Because as I said, there have been questions in the exam, if you remember, where we were talking in terms of that empty bottle example. So you could get questions on the definition. So you need to be very clear on the focus of the word assets. And along with the definition, your mind should immediately shoot out at the clarifications which I gave you in terms of the packing material and in terms of the publicity material. The second focus area which we concentrated is in terms of the measurement principles related to inventory. And the focus was on para number 9. The focus was in terms of para number 32, especially looking at the raw material inventory valuation, which depends upon the FG valuation. And then we turned a focus that what is cost, considering that what is included in the cost, what is excluded from the cost, and what depends, that it may or may not be included. And then we covered 3 special issues with you related to the concept of cost. Your mind should start working on the special issue. One is related to the deferred credit, applying the concept of unwinding of discount. The second focus in terms of joint products and the concept of byproducts, and understanding the concept of the cost formulas. That do we consider the inventory based on the historical cost or the non-historical cost, etc. And finally, we covered the aspect in terms of NRV. And remember, the measurement itself talks about the cost, it talks about the NRV. So we went into the finer details of NRV. What is NRV? What is the concept of estimation, Ind AS 10 impact? How do we compare NRV item by item? How do we consider a reversal impact? What is the measurement? How the para number 9 is applied when there has been a write down of inventory on the first balance sheet date. So these are the 4 major focus with which this standard covers the entire concept. So I think now it's time that you could revise the entire standard in a complete go, do the questions, practice them well, and then I think you are ready to attack questions if you find any, because I have tried to put in my book all the questions which are related to inventory, whether it's going to be past examination, MTP, RTP, study material, education material, Ind AS bulletins, everything at one place. So I hope, friends, you found all this relevant for you. So I'm going to see you back soon with some of the topics now. So thank you and take care and goodbye.